So we are going to look at borrowing cost, and we also look at government grants. Borrowing cost is not just we are going to look at the meaning of borrowing cost. No, we are going to look at borrowing cost and also the treatment, the accounting treatment for borrowing costs. We are also going to look at government grants, what we call government grants and what we call government assistance, and what are the types of grants that we have and how do we account for them. So we are going to look at those issues right now and see what we are going to do. Okay. Okay. So we are going to start with the borrowing cost first, which is the IS 23. Borrowing cost. Okay. All right. You see, basically entities can acquire whatever they want to acquire through a lot of means. They can acquire the item through cash, or they can also acquire the item through or on credit basis. So they can either pay cash or they can get the item on credit and pay later. Okay, but the issue now is if they want to acquire the item by using cash, they also have means that they can get the cash to buy the item. So the company can use their own money, or they can They can go for a loan or assistance from a different person to purchase whatever they want to purchase. Okay, so a company may want to acquire motor vehicle. So a company may want to acquire a motor vehicle. Okay, so this particular motor vehicle, the company can go, maybe the price of the motor vehicle is 5,000. The company don't have cash. So what they will do is that they can go for a loan to purchase the motor vehicle at 5,000. What is going to happen to this loan is that at the end of every year, the company will be paying interest on the loan. Okay, the question is, why do we contract the loan? We contracted the loan because of what? We want to purchase the motor vehicle. So if the loan is going to last for 5 years, if the loan is going to last for 5 years, it means that we are going to pay interest for 5 years. Okay, the question now is, how many years is it going to take us to get a motor vehicle ready? So if it is a motor vehicle that is incompleted, it's a motor vehicle that is incompleted, or it's a work in progress that we have purchased. So let's assume that we have purchased a motor vehicle that is a work in progress for 5,000. We have to complete it ourselves. We have to complete it ourselves before it will be ready for use. So our loan will last for 5 years. Our loan will last for 5 years. But a motor vehicle, we have to work on the motor vehicle for additional 2 years before we can start using the motor vehicle. Before we can start using the motor vehicle, we have to work on it for 2 years. Okay, so if the interest is 500 every year, okay, if the interest is 500 every year, it means that we are going to pay the interest for 5 years. Okay, these 5 years, we can faithfully say that the interest for 5 years, okay, 2 years will go for the motor vehicle, okay, and 3 years will go for profit or loss as an expense. Why are we saying that the 2 years will go for the motor vehicle? Because the loan is for 5 years, but within the 5 years, we were able to construct or to get a motor ready or to work on a motor for 2 years before it will be ready. So we can confidently say that since we are taking the loan because of the motor vehicle, we can say that the 2 years of the interest can be added to the initial cost of the assets. So we can decide to say that, okay, since we are taking the loan for the motor vehicle, 2 years, because the motor vehicle will be ready for use in 2 years' time. So the 2 years of the loan interest is a cost that is necessary to bring the motor vehicle to the state that it will be ready for use. It's an initial cost that is incurred to bring the motor vehicle to the state that it will be ready for use. All right. So basically, whenever there is a loan interest, what the company have to do is that they have to expense the interest to profit or loss. But there are specific situations where the interest or the loan interest can be added to the initial cost of the assets. Can be added to the initial cost of the assets. So you will not expense the interest, but you add it to the initial cost of the assets. What are those circumstances that this can be done? So we are coming to look at what we call a borrowing cost, and when should a borrowing cost be added to the initial cost of the assets? And which type of asset should we add the borrowing cost to its initial cost? And when should we stop adding the borrowing cost to the value of the asset? That's what we are going to look at. If you talk about borrowing cost, we are talking about cost incurred in connection with borrowing of funds. So borrowing cost. If you talk about borrowing cost, any cost that you incur in arranging for funds, or any cost that you are going to incur to borrow funds. Your back, your back. Let's put this now. Okay. Please, can you hear me?
Yeah, I can hear you.
Okay.
We can hear you now.
Okay. So we are saying that borrowing cost. If you are saying borrowing cost, you see any cost that you are going to incur to obtain a loan, or any cost that you are going to incur as a result of you going for a loan, or you going to borrow funds from a person. That is what we call the borrowing cost. So the processing fee, the loan processing fee that you are going to be paying, the loan processing fee that you are going to be paying will also be what we call a borrowing cost, because it's a cost that you are incurring in connection to to the loan that you are going to take from a bank. Okay. You can also, the processing fee can also be called a transaction cost. Okay. So the transaction cost is also a cost that you are going to incur. It's a cost that you are going to incur in connection with borrowing of funds. You can also incur a cost which will be a premium. Maybe they will say that if you want to pay for the loan, the time that you are going to pay back the loan, you pay at a premium. So you can say that the premium is also a cost relating to the loan. If not for the loan, you are not going to pay a premium or an amount that will be a premium on the amount that you have borrowed. Okay. You can also receive the loan at a discount, or you can also issue the loan at a discount. If you issue the loan at a discount, the discount you are going to suffer it, or you are going to suffer for the discount, because you should have issued the loan, or you should have issued the amount as 2,000, but you are giving it to the people at 1,900. So the discount over there is a cost to the entity. Why are you incurring the discount? It's a result of you issuing a loan note, or a bank can also give you a loan at a discount. So the discount, you are going to be enjoying the discount. Why are you enjoying the discount? It's a result of you obtaining the loan facility. You can also be given a loan that if you are going to pay for the loan, you are going to pay at a premium. That particular premium is also a borrowing cost. Okay. Bank overdraft. Bank overdraft can also be a borrowing cost. Okay, the interest on bank overdraft is also an example of borrowing costs. So interest on bank overdraft is an example of, so bank overdraft interest is also an example of borrowing costs. Okay, all the interest that you are going to be paying, they are all borrowing costs. Anything that is relating to a loan, any cost that you are going to incur as a result of borrowing are all borrowing costs. But the question now is, which type of borrowing cost or which form of this borrowing cost should we capitalize? Capitalization means adding it to the initial value of the asset. We can also have foreign exchange differences. So there can be foreign exchange differences, foreign exchange differences, or loss on foreign exchange differences arising from what? A loan that you have taken, arising from borrowing in a foreign currency. So in a foreign currency, we will take them one by one and explain. We can also have a finance cost relating to what? An operating lease. So finance cost relating to an operating lease. A finance lease rather, not an operating lease. Okay, relating to a finance lease. So we take them one by one and why they are borrowing costs and why we should capitalize them relating to a finance lease. A finance lease. Okay. So the processing fee, you are going to pay this amount before you can what? You can access the loan. Okay. So maybe you are going for a loan of 20,000. Okay. And the interest is 10%. But before you are going to take this loan, the bank has asked you to pay 500 as a processing fee. That's a transaction cost. Okay. The question now is, how many years are you going to pay the loan? And the asset that you are borrowing or you are taking the loan for, how many years is it going to take the company to what? To construct or to make the asset ready for use? So if the loan will be for 5 years, if the loan will be for 5 years, let's come here. If the loan will be for 5 years, if you are going to pay the loan for 5 years, and the asset that you are taking the loan to construct, the asset that you are taking the loan to construct would take 2 years to complete. It means that the processing fee, okay, it means that the processing fee, which is 500, is relating to a loan that will last for 5 years. So it means that the processing fee must also be consumed over what? 5 years. So what will happen is that at the end of every year, we are going to be charging 100 cedis as the amortization of the processing fee. So if the asset is going to last for 2 years, that means that 200 out of the 500 will be added to the initial cost of the asset. So you only amortize the what? The processing fee or the transaction cost. You amortize it. Then you apportion it to the asset based on the number of years or the number of months that the asset is going to be taking to get completed. This is if you have a nominal interest rate of 10%. So this one, they just give you the nominal rate of 10%. Okay, but if they give you effective interest rate in the question, which might be maybe the effective interest rate might be 12%, then what you do is that you account for what? This particular loan in accordance with financial instruments. So you subtract your transaction cost from this one, then you charge the 12% on the what? On the net amount, which will be 19,500. That will be the amount that you are going to add to the cost of the assets. Okay, but let's take it one by one. Let's take it one by one and explain. Okay. So let's come here. Borrowing costs are defined as interest and other costs that an entity incurs in connection with the borrowing of funds. The standard list of what they may included in borrowing costs. Okay, the first one is interest on bank overdraft or short-term what? Borrowing. So any interest or any amount that you are incurring in connection with borrowing of funds is what we call a borrowing cost. Okay, but the question now is, if the bank overdraft that you are using the bank overdraft on an asset that is called a qualifying asset. If the bank overdraft, you are taking the bank overdraft to finance an asset, which is a qualifying asset. What then is a qualifying asset? An asset that is going to take a substantial period to be ready for use. The standard does not define what a substantial period, but if it is maybe 4 months and above, we can say that is a substantial period, or even 6 months. So if they are saying 6 months, it's also a substantial period. But if it is 4 months or 3 months, but it should not be 2 weeks or one month is also okay. You can also capitalize the 1 month interest. So maybe 1 month can be a substantial period to some people, but the standard does not define what we call a substantial period. So you have to use your professional judgment to determine what a substantial period is. But since you are going to be reporting maybe on monthly basis, you can also use 1 month if the asset is going to take a month to be completed. You can charge the borrowing cost for that 1 month and add it. Hey, is it my network will be very bad? Okay, it's very bad. You go to come. Won't be stable. Like it be my other phone there, it will be stable. Is it okay now or is still? Is it okay now or still? I can't see this thing. I can't see the mic talking. Your MTN good. Hotspot means you on the hotspot. Okay. So I was talking about, okay, let me take it again. Let me take the borrowing cost again. So borrowing cost is defined as interest and other costs that an entity incurs in connection with the borrowing of funds. Okay, so any amount that you are going to incur or any interest that you are going to be paying on amount that you have borrowed or on a loan is what we call the borrowing cost. Even the transaction cost that you are going to, or the processing fee that you are going to pay to obtain the loan facility is also what? A borrowing cost. So any cost that is associated with what? Borrowing of funds is what we call the borrowing cost. But the question now is, which of these borrowing costs should we add to the initial cost of the asset? And which type of asset should we add the borrowing cost to? So you can have overdrafts. A company can be operating an overdraft facility that they are going to be paying interest at the end of every year. The question now is, what is the purpose of obtaining the overdraft? Are we taking the overdraft to finance a construction of an asset that is going to take a number of years to get completed? If that is the case, then we add the interest for the duration that the asset has been taken to get ready for use. So if you obtain the overdraft facility to finance construction of building, okay, the issue now is how many years are you going to pay for the overdraft? How many years are you going to pay for the interest? If it is 5 years and the overdraft was taken to finance the construction of the building, and the building is going to last for 2 years, then it means that 2 years out of the 5 years interest should be added to what? To the initial cost of the building. So if the building is complete, the interest will no longer be the cost that is necessary to get a building ready for use. So borrowing cost is capitalized on what? A qualifying asset. What do we mean by a qualifying asset? Asset that is going to take a substantial period or a number of what? Period or number of months or number of years to be ready for use. That is why we are talking about substantial period. However, the standard does not define what a substantial period is. So if the asset is going to take 1 month, you can say the 1 month is a substantial period for you because you can charge interest on monthly basis. You can charge interest on monthly basis. But if the asset is going to take 2 weeks, you can ignore the 2 weeks. because charging interest on weekly basis will be an issue. Or if you are, so weekly, maybe 2 weeks or a week, you can ignore the borrowing cost. But a substantial period, maybe 1 month is okay, 2 months is okay, 4 months, 6 months, and those of, so the question, since you are writing the exam, the question will give you the period that you have to, they will give you the substantial period, which will always be maybe 3 months, 4 months, 6 months, and those ones. But the standard does not define what a substantial period or the range of the substantial period. But any period that you think that is reasonable for you to work, or any period that you can charge interest for. If it is a month, you can charge interest on monthly basis. The network is still breaking.
I know, I think it's okay now.
It's still okay.
Yeah, it's okay now.
Okay, thank you. So the standard does not define what we call a substantial period. So you have to determine a substantial period. But if the borrowing cost is incurred or the borrowing cost is incurred on a qualifying asset, then the portion of the interest or the portion of the borrowing cost or the period of that particular borrowing cost should be added to what? To the initial value of the assets. All right. So we look at the interest on what? Bank overdraft or on any short-term borrowings. Let's look at amortization of what? Discount or premiums relating to what? Relating to borrowings. Okay, what do we mean? You see, we have issued a loan, or we have taken a loan. The value of the loan should be 20,000. Okay, the value of a loan should be 20,000. But the people have given us what? They have given us the loan at 19,000. It means that the loan was given to us at a discount of 1,000. This particular discount is an income to us. But why are we enjoying the discount? We are enjoying the discount as a result of the what? The loan that we are taking. So what we do is that this particular discount, which is an income, we are going to be doing, if the discount is 1,000, the question now is how many years is the loan going to be taken? So if the loan will take 5 years, we amortize the discount over 5 years and take the portion that's supposed to be what? Added to what? To the initial cost of the asset. So if the asset is going to take 2 years, it means that we are going to be taking a discount of what? 400 cedis to be part or to be subtracted from the cost of what? The asset. So what you do is you charge your interest on the full amount. So you charge your interest on this amount. The interest will be charged on the 20,000. Then you now net the interest with the what? With the discount cost. Or you charge the interest on the net amount. Then you leave the discount because the discount is now bringing the value to 19,000. But if you are charging the interest on the full amount, then it means that you have to charge, or you have to net the what? The discount against the what? The interest. So you can also amortize the discount. The discount will be for 5 years. You amortize it. What portion of the discount is supposed to be subtracted or added to the what? To the initial cost of the what? The assets. There can also be another way that the company can issue the loan notes. The company can issue a loan note at a discount. So we are issuing a loan note at a discount. So that will be maybe the loan note is 20,000, but we are selling it at 19,000. You see that the interest will be charged on the full amount. But what is going to happen is that we are incurring additional cost of what? 1,000. So this particular cost is an expense, but this will be amortized over the number of years that the loan is going to be with us. So if the loan is 5 years, we divide this one by 5 years, then we get 200 every year. So the question is, how long would the asset take to be ready for use? So if the asset will take 1.5 years, it means that we are going to be adding 300 to the what? To the initial cost of the asset. We amortize the discounts and either add or subtract depending on who is what? Incurring the discounts. Okay. The same way can also be a premium. We can also issue a loan at a premium. we can also issue a loan at a premium. So if you are issuing a loan at a premium, assuming the loan is supposed to be 20,000, but we are issuing the loan at a premium of 2,000, it means that we'll be receiving 22,000 from the issue. So we are going to charge the interest on the 20,000. But the 2,000, which is an income to us, we are going to amortize it over the number of what? The loan period, and every year we will take that one as a deduction. So every year we'll be charging 400. So if the asset will take 2 years, it means that every year we subtract what 400 from the what? From the initial cost of the asset, because the premium is what? Is an income to us. So we subtract from the cost. But if it is the bank that is issuing the loan at a premium, if it is the bank that is issuing the loan at a premium, it means that the bank is now giving you the loan at 22,000. So the loan amount itself is 20,000. You charge the interest on this one, but you are going to pay additional cost of what? 2,000. So this will also be amortized over the what? Over the number of what? The loan, or over the period of the loan. Then every year you add the portion that's supposed to be added to the initial cost of the asset. So the amortization means spreading the what? Either the premium or the discounts. So what will be the effect of the premium? If the premium is going to be a reduction, then for that particular period that the asset is under construction, you go and reduce the initial cost of the asset by that particular amount. If it is going to be an increase, then you add. The same thing applies to what? To the premium. Any question about that before I move on to the auxiliary cost in connection with what? With the borrowing. Are we clear with the amortization? Seniors, are we?
Yes,
Okay, so I can move on to the next one. Okay.
sure.
Okay. The next one is the amortization of auxiliary costs incurred in connection with the arrangement of the borrowing. So it can be the transaction cost. So it can be the processing fee. Okay. So the loan itself is 20,000. Okay. The interest is 10%. Okay. So it means that you'll be paying 10% interest separately on this one, but you're also paying a transaction cost of 200 or 2,000 before getting the loan. This is an additional cost to you. Why are you incurring this cost? It's as a result of you borrowing the funds. So it's a borrowing cost. So the question now is, how long will the loan take? If the loan is going to take 10 years, it means that you amortize, you spread the 2,000 over 10 years. It means that every year you take 200 to either profit or loss, or you add it to the cost of the asset. So if the asset is going to take 6 months to be completed, it means that you charge 6 months of this one and add it to the initial cost of the asset, because it's a cost. So you add. Okay. This is if the interest is what? Is fixed. If you are having fixed interest rate or a nominal interest rate. Under the principles of financial instruments, we say that they are going to give you effective interest rates. The effective interest rate take into consideration the 100 that we'll be adding, and also the 10%, which will be 6 months, which will be 1,000 every year. So we are going to be having 1,100 as the cost, as a borrowing cost to be capitalized. Okay, this is if you are not giving effective interest rate. So this will be charged separately, and this will also be amortized separately. Okay, they can give you a rate, maybe 12%. This particular rate will take into consideration the interest of 10% and also the amortization of what? The 100 cedis every year. So what you do is that the loan, the processing fee will now be capitalized. You capitalize the processing fee. Capitalizing means that you subtract it from what? The loan, because the loan is a financial liability. You capitalize the transaction cost. Then you now have 18,000. So the 18,000, you now apply the effective interest rate on this one. So if you apply the effective interest rate on this amount, it has now already taken into consideration the amortization plus the interest. So if you are giving effective interest rates, then you account for the loan as a financial liability, where you are going to amortize the transaction cost, the premium, the discount and any other thing that's supposed to be added or subtracted.
Senior,
Yes, please.
I bet you have to take that point again.
Okay. I'm saying that the amortization is always done when you are giving a nominal interest rate. The nominal interest rate means that the interest rate is affecting only the loan amount. So this 2,000, which is an additional cost, is not part of the interest that you'll be paying. So you amortize this and send it to what? And add it to the initial cost of the asset together with the interest. But sometimes they can give you effective interest rate. The interest rate over here is 10%, which is the coupon rate. They can give you effective interest rate of 12% in the question. The effective interest rate has taken into consideration the interest itself, which is the 1,000, 6 months, and the transaction cost of 100, which is 6 months. So it means that if you apply this particular amount on a net amount, you are going to be getting the 1,100. That is the meaning of the effective interest rate. The meaning is that we have capitalized the processing fee and now applying what? 12% on the net amount. So you account for this particular loan in accordance with IFRS 9 financial instrument, where you are going to be capitalizing the transaction cost, which is the processing fee. Capitalizing a cost means that you are debiting the cost, but this is a liability. Debiting liability means that you are reducing the liability. So you subtract the 2,000 from the 20,000, then you apply the effective interest rate on the net amount. So you just use the finance cost as in the financial instrument. There is a question there. Last sitting question for financial reporting is this one. So if I take that question, maybe the understanding will be clear, because since I'm using assumed figures, it will not be clear. So let me use a question with computation that will be much clearer than what we are doing here. Okay. So what I'm trying to say is that if there is an effective interest rate, any cost associated with the loan will be capitalized, and we use the effective interest rate as the interest that will be capitalized. Okay, let's look at exchange differences arising from foreign currency borrowings to the extent that the company they are regarded as an adjustment to interest costs. Okay, let's now come here. Let's assume that we have taken 2,000 USD dollars to finance the operation here. Okay, to finance the construction of the assets. Okay, so we are going to say that at the end of every year, we are going to be looking at, or we are going to be fair valuing the loan, because we are going to pay in a foreign currency. So let's assume that at the date of this one, the exchange rate is 5 CD is to $1. Okay. At the reporting date, it is now 6 CD is to $1. And this one, the asset is still under construction. So we are done first year already. What we are going to do is that if you want to pay these particular people at the date of the transaction, it should have been 10,000 Ghana cedis if you want to pay them in a CD equivalent. By the end of the year, if you want to pay them, you are going to pay them 6 CD at $1, and that will now be 12,000. Okay, you can see that there is a difference of 2,000. Okay, this difference under normal circumstances, it should be sent to profit or loss as what? Loss on exchange or exchange rate losses or something. But this one, we are taking this particular loan specifically to finance the construction of the asset. So instead of us sending this one to profit or loss, we add it to to the initial cost of the asset. If the asset is a qualifying asset, that's what they mean by the exchange differences. If it is the loan is taken specifically to finance the construction of the asset, then the difference will be added to the initial cost of the asset. All right, let's look at the last one. Finance charges in respect of finance leases recognized in accordance with IFRS 16. Okay, someone will say that, okay, I was able to understand the first point, the second point, the third point, and the fourth point. But how would a finance cost or finance charges in finance leases be part of the initial cost, or be part of the borrowing cost that will be capitalized? It's very simple. Assuming that you are going to construct a building, okay, and constructing this particular building, you have leased equipment. Okay, you have leased equipment on finance list. Okay, why are you taking the equipment? You are taking the equipment because of the construction of what? The assets. So it means that if the lease period is 5 years, you are going to be charging interest for 5 years. So since you are using the equipment to get the building ready for use, the finance cost that is relating to what? The lease, the portion of it that is relating to the period that the asset is going to be ready for use must be added to the initial cost of the asset. That's what they're saying. So if the lease period is 5 years, the building will be ready in 1 year. In a year time, it means that the period that you have started the construction of the building to the time that you are going to what? You are going to what? Complete it. The finance cost relating to this particular lease of the equipment should be added to the initial cost of the asset. Why? Because the building, the equipment that we are leasing, we are using the equipment as part of the process to get the asset ready for use. The same way you can also lease a land. You can also lease the land on a finance lease where you are going to construct the building on the land. Without the land, you can't construct the building in the air. So the finance cost relating to the period that the building is ready for use, from the construction date to the day that it is completed, the finance lease over there, or the finance cost relating to the finance lease should be added to the initial cost of the what? The assets. Because at that time, the asset is still under construction. And the land is also one of the activities to get the what? The building ready for use. Okay. However, if the asset is already in a condition that it can be used, the borrowing cost will not be what? Will not be capitalized because the asset is now available for use. We can't incur any other cost. We can't incur any other cost to bring the asset ready for use. So if a company takes a loan to purchase an asset that is already in a stage that they can start using it, maybe they purchase a motor vehicle that they can start using it immediately, the borrowing cost will be what? Will be expensed. But if the company has to do a work on the what? On the motor vehicle, which is going to take a substantial period, let's say 2 months, 3 months, 4 months, 5 months, so the borrowing cost relating to that 5 months should be added to the initial cost of the asset. So borrowing cost, capitalization of borrowing cost is only for assets that are qualifying assets, assets that will take a substantial period to be ready for a use. All right. So that is about the finance cost. The question now is, okay, if a company take a loan or the company took a loan to finance construction of what? A plant. Okay, but for the preparation towards the preparation of construction of the plant, they have acquired a land to construct the plant on it. The question now is, should we only capitalize the borrowing cost relating to the construction of the plant, or the interest that we are going to pay on the amount that we have used to purchase the land? We are also going to capitalize the interest relating to the land. Which of them? Would the interest on a borrowing cost relating to acquisition of land for construction of plants, would that particular cost also be what? Be capitalized as part of the what? The initial cost of the plants. Is it going to be, do we capitalize a borrowing cost on land or not? Should borrowing cost relating to an amount taken to acquire a land be capitalized? Should it be capitalized? Borrowing cost relating to acquisition of land, should it be capitalized? If yes,
Yes.
okay. If yes, why yes? If no, why no?
No.
Okay. If no, why? If yes, why? Okay. So we take the yes,
Okay.
the person who said the yes. So the yes, why should it be capitalized? The person who said the yes. Or is the same person who said the no?
No. I only said no.
Okay. So Senior James, why is it no?
Think that land is not a qualifying asset.
Okay. Okay.
And again, land I don't think we have any definite reason to say, oh, it's ready for use or not.
Okay.
Like taking that substantial time period to qualify for it before you can get it to be ready for use. That I'm not too sure there is any means by which it can be measured.
Okay. But do you know that you can
But
also
my main point is that it's not a qualifying asset.
okay. But you do also know that you can purchase a land that you want to do leveling before you start using the land.
Say again.
Do you know that you can purchase a land that you say you want to level, you want to do leveling? Maybe where you acquired a land,
Leverage.
yeah, like a lot of issues that you have to bring the land to. Maybe you want to raise it to more. Maybe if you buy the land at those where there will be our area, the Aplau area there, because our place over there is a water
water
law.
law.
Yes, so you have to raise the land small before you start using it. You can see that you are also undertaking activity to bring the land to the state that it is ready for use.
Okay.
So how long would that particular activity take? If it's going to take maybe 6 months or 4 months, that is fine. But the capitalization of borrowing costs relating to a land depends on the purpose for the acquisition of the land. So if the land, you acquire the land for immediate use, it means that the land can be put into use immediately. The borrowing cost cannot be capitalized because the land is already ready for use. But if you acquire the land with the purpose of construction of other assets, like a building, so you can see that the acquisition of the land is also part of the activities to get the building ready for use. Without the land, you can't construct in the air. So if the land is acquired for the purpose of construction of another asset, then the borrowing cost on or the interest that we are going to be paying on amounts that we have taken to finance the land will be added to what? To the initial cost of what? The land and building. But if the land can be put into use immediately, then we can't capitalize because the land is already in a state that we can start using it. But if you are not acquiring the land for construction of another asset, but you are going to do leveling, you want to raise the land to a certain level before you can start operating on it, then it means that that particular activity that you are going to undertake might take some time before it will be completed. So the leveling cost itself will be added to the cost of the land because it's part of the cost that is being incurred to bring the land to the state that it is ready for use. And the borrowing cost relating to the amount that you have taken to purchase the land will also be capitalized from the time of acquisition to the time that the land is ready for use, or how long the leveling has taken. Maybe 6 months, you are going to capitalize 6 months of the borrowing cost. All right. So after the asset is ready for use, we don't capitalize again. Okay. So capitalization of borrowing cost relating to the land, the first thing is the purpose for the acquisition of the land. If it is for other assets, construction of other assets, then it means that acquisition of the land is seen as part of the activities to get that particular asset ready for what? For use. Okay, senior. So take note of that. All right. Okay. All right. Let's come to what the standard, the examples that the standard has given as what? As a qualifying asset. So we have inventories. Okay. The inventories, it can be inventories that you are going to produce for sale. Okay. So, but if the inventory is going to take a substantial period like 6 months to complete, then we can capitalize the borrowing correlating to what? To the inventory. Okay. Manufacturing plants, power generation facilities, intangible asset like software. So if you take a loan to finance the development of the software is going to take some time to be ready. So you capitalize the borrowing cost relating to the development period of the intangible. We also have investment properties. We can also acquire an investment property and carry out certain work on it before it will be ready for use. We can also be constructing a land or a plant that we have the intention of giving out to people for rentals. So we can also construct an investment asset. It depends on the purpose for the construction of the asset. It can be for our own use, it can be for rentals, it can also be for sale. All right. So financial assets and inventories that are not manufactured or otherwise produced over a short period of time are not qualifying assets. Assets that are ready for their intended use or sale when purchased are not what? Qualifying assets. Only the asset that is going to take a substantial period before it will be ready for use. It's not only asset under construction. You can also purchase an asset, or you can also purchase a motor vehicle, and you realize that the condition that you want the motor vehicle to be before you start using it, the motor vehicle is not at that particular condition. So you have to carry out a work on it for it to be ready. If you take a loan to acquire it, then it means that the interest relating to the period that you have taken to get the motor vehicle ready for use, the interest relating to that particular period must be what? Capitalized. But the question is, when do we start capitalizing the borrowing cost? When do we start adding the interest or the borrowing cost to the initial cost of the asset? You can take the loan on 1st January 2022, but construction has not taken place yet. So it means that you can add, there's no cost incurred for the asset. So what cost are you going to add the borrowing cost to? So you can take the loan on January 2022, but construction will start maybe June 2022. The meaning is that from January to May, there is no construction, there is no cost incurred on the asset. So what are you going to add the borrowing cost to? So you expense the borrowing cost from January to what? To May. If from June to December, the asset is still under construction, then we only capitalize the borrowing cost relating to the period that the asset is under construction. So capitalization will start from June to what? To December. Okay. It can also happen that the construction of the asset, you are using equity. So you have started constructing the assets, or you have started the construction of the building on January 2022. Okay. But this one, you are using your own reserves, you are using your own cash. But on July 2022, you have realized that no, the money that you have to finance the construction, your money, you are out of cash. So you have to go and take loan. In that case, the capitalization of the borrowing cost will start from the time that's what the loan was taken, because the asset is still, or the asset is already under what? Under construction. So the conditions, we are going to look at the conditions that have to be met before we start what? Capitalizing the borrowing cost. You can take a loan to finance the construction of an asset, but you haven't started the construction yet. You can't capitalize the borrowing cost because there is no asset that you have to add a cost to. There is no asset under construction. So let's look at, when do we start capitalizing? And what asset do we capitalize borrowing cost for? It is qualifying asset. When do we start capitalizing the borrowing cost? What should be the conditions? What should be the conditions? Okay, let's look at the borrowing cost capitalization. Borrowing cost capitalization commences when expenditure for the assets are being incurred. When expenditure for the assets are being what? Incurred. So let's assume that we want to construct a building. Okay, if you want to construct a building, what we need to do is that we need a cement. Okay, we need sand. Okay, without the sand and cement, we can't start construct. We can't start what? Constructing the what? The assets. So maybe we have bought a cement, we have bought land. These things are bought towards the construction of the building. So we can say that the expenditure for the asset has taken place because we have bought cement, we have also bought sand, or we have paid to the what? To the contractors. It means that we are going to what? Start what? Constructing the asset, constructing the asset under consideration, or the actual work on the asset has taken place and we have paid the people. That is where the expenditure for the asset has been incurred, or we have what? Paid the contractors, or we have purchased some of the items that are necessary to what? To start what? The construction. Okay, borrowing costs are being incurred. Borrowing costs are being incurred. It means that you have actually what? borrow towards the what? The construction of the assets. So you have borrowed and you have to pay interest. So that means borrowing costs have been incurred. Activities that are necessary to prepare the asset for its intended use also are in progress. So what we have to do is that maybe we want to construct a building, we have to clear the land. So we have to clear maybe the place is bushy, we have to clear the bush, or they have started what? Digging what? Holes for what? For the laying of the blocks. So that the activities necessary to get the asset ready for its use are in place, or they have actually started what? Construction of the construction of the assets. So it means that we have started the construction of the assets. Everything is ongoing, and in a short time, the assets will be ready for use. That is what they mean by. Okay. All right. So let's look at, these are the conditions. All these three conditions must be met before you start capitalizing borrowing costs. You can borrow to construct the assets, but the construction has not taken place. What figure are you going to add the borrowing cost to? Okay. You can purchase the cement, but there's no sign that we are actually going to what? Construct the building. There's no sign. The place is still bushy. The place is not cleared. And there can be a lot of evidence to show that, okay, the company is likely to be using the cement for a different thing, not this particular asset. You can also start the construction of the asset, but borrowing costs, you haven't taken money to finance the operations of the asset. It means that you're using your own money. You can't capitalize borrowing costs because there is no borrowing. All right. Okay. Let's look at okay. Let's look at this. I have said this one. The cost of borrowing, which borrowing is made before the construction of asset begins, must be expensed or for the period before the commencement of the asset construction. I have said that one before. When a construction work begins long before a borrowing is made for the purpose of the asset under construction, capitalization of borrowing costs begins from when the borrowing is made, but not from the time of the commencement of the construction of the asset. I have also used an example for that particular one. Okay, so if we start the capitalization of the borrowing cost, the criteria are being met. There can be a situation where maybe the construction of the asset might be put on hold or something. Okay, one thing that you have to know is that you can start the construction of the assets. Then what will happen is that the workers will go on strike. The workers will go on strike. It means that the work is going to stop for a certain number of period. But the issue now is the workers going on strike is an activity to improve the condition of the building. Is it an activity that will better the construction of the building? Is it an activity? No. So if you have started a capitalization of borrowing costs, any activity that is going to occur, which is not relating to administrative activities that will better the construction of that particular asset, the capitalization of borrowing costs must cease from that particular or during that particular period. Example is the workers going on strike. We also have litigation issues where they will say that stop work, produce permits. Stop work, produce permits. Or there can be a shortage of raw material. There can be a shortage of raw material. So if these activities occur, capitalization of borrowing costs should cease from the time that this activity occurs to the time that it will end. Okay, but what if what is causing the work to stop is a workshop, or it's an activity that the contractors have to go for a workshop for them to now have a new knowledge about certain design that they have to do. You have to go that the training that they are going to, you have to know the training that they are going to undertake will be something that is going to add value that is going to add value to what they are going to do. So we will still assume that the construction is still under progress. So borrowing costs will still be will still be capitalized. Okay. It must be noted, however, that where a temporary delay is necessary part of the construction process, borrowing costs must not be suspended. Thus, a suspension of borrowing costs is not necessary for temporary delays or for periods when substantial or technical or administrative work is taking place. So administrative work, maybe we want the people to stop working so that we now construct a big place so that water will not be coming to where they are doing the construction. It's also part of an activity to improve the condition of the assets. But if the activity is not something that is going to improve the condition or improve upon the condition of the asset, then borrowing costs must be capitalized. Example is litigation problems, stop work produce permits, strike, shortage of raw material, and all those things. They have to be the capitalization must be must be ceased, not stop, must cease. You continue after the construction resumes. Okay. When do we say, or when do we stop capitalization of the borrowing cost? Okay. We are capitalizing the borrowing cost from the time that the asset is, from the time that we are preparing the assets to be ready for use. So it can happen that you have completed a building now. Okay. You have completed a building now, and the building is now ready for use. It means that no work will be done on the building again. So capitalization must cease when the asset is ready for use. Okay, when the asset is ready for use, or when a greater part of the asset is ready for use. Okay, you can see that we have building. We are constructing the building. Okay, people can actually live in the building without being cemented, without a building, instead of building being cemented. People can actually live in the building like that. People can also move into a building without doors or windows being fixed on the building. So as soon as you have completed the building, people can actually move in and be managing it. So if it should be about windows, facing of the windows, they are not major work that should be carried out on the asset, and people can actually use the building without the windows and all those things. So if greater part of the asset is ready for use, then capitalization must also cease. But the question is, if you are constructing a story building, it means that the completion might be done in stages. Maybe before you first finish the ground floor, you finish the down, but you are here to finish the top. So it means that capitalization of the borrowing cost will cease for the part that you have completed. But the part that you are here to be completed, you continue capitalizing the borrowing cost for them. So if the completion is done in stages, the stage that you have completed, capitalization will cease for them. The stage that you are here to complete, capitalization will continue for them, like a story building. I want to bring in something before we look at the types of borrowing that we can do. I want to bring in something. Okay. What I want to bring in is that if you are looking at under the provisions of IFRS 15, okay, revenue from contracts with customers, we also call something construction contracts, where you are going to enter into a contract to maybe construct maybe roofs or building or dam for one particular person. The recognition of the revenue is in two folds. It can be a point in time or a point over time. A point in time means that when control has finally been passed on to the customer. So if the thing is going to take 2 years, you can only recognize revenue when you have finally transfer ownership, control to the third party. But recognition over time means that as far as you complete part of the work, you recognize revenue relating to that part of the work that you have completed. The assumption is that if I'm constructing a building for you, a story building, if I finish the ground floor. You can move in with your family and now ask me to work on the top. It is done everywhere where people will move in to occupy the place that has been done, and the people will start working on the remaining parts. So if it is over time, we don't have any issue. But if it is at a point in time, it means that if we start a construction, we can only recognize revenue after 2 years. That is when we have what? Transfer ownership to the what? To the third party. It can also happen that the third party will make an advance payment. At the time that we sign the contract for the construction, the people can give us what? 20,000. We haven't given the asset to them, but they have given us 200,000. So this 200,000 will be treated as a loan. So what it means is that the company is taking this 200,000 to finance the construction of what? The asset that will last for 2 years. So since you are taking the loan over here, it means that the advance payment that you receive from the person will now be seen as what? As a loan to finance the asset. So you treat this one as a borrowing cost and capitalize for what? For the 2 years. That is if the revenue is recognized at a point in time. But if it is at a point over time, you recognize revenue upon completion. All right. So take note of that. They can give you a question on or in IFRS 15 that you have to apply the principle of the 23, which is borrowing cost. Okay. Okay. Let's come to the type of borrowing that we have. Okay. The type of borrowing that we have. Okay. Sometimes we can decide to use our existing borrowings to finance the construction. Or sometimes we can also decide to go for a new loan purposely for the what? For the construction of that particular asset. So we have two types of what? Borrowings. We have the specific borrowing. The specific borrowing is a fund that is contracted purposely for the construction of what? That particular asset. It will not be used for any other purpose apart from what? The construction of that particular asset. If that happens, what will be the interest, or how are we going to compute the interest that will be capitalized? If you are taking a loan of 20,000 to finance the construction of the asset, this loan will be used for the asset alone. Even if you use 1 cedi of this particular amount, you will still charge the interest on the full amount because you have taken 20,000 to finance, but you decide to use only 1 cedi. So the interest or the borrowing cost over here, the borrowing cost for specific borrowing will be the actual interest, even if you use part of what? The fund. Okay. If you use only 1 cedi, as far as you have used part of the fund on the construction of the asset, you are going to charge interest on the full amount. So you can decide to use 5,000 first. Okay. So, but you charge, if the interest is 10%, it means that you are taking the 20,000 fully for the construction of the asset. So you are going to pay the interest. If not for the construction, you won't take the 20,000. So you charge 2,000 as the actual interest, if it is a full year, as the actual interest. But the question now is, you have used only 5,000. Okay. If you are a rational being, what you do is that you are going to find a short-term investment where any amount that is what unutilized over here, you put it in a short investment. So the interest that you are going to be paying will be 2,000, but you have only used 5,000 on the asset. You can't put the 15,000 there and say that whenever you need it, you come for it. If you are a rational being, you are going to invest this one into a short-term investment. And as at when you need the money, you go and withdraw it. So what we'll do is that you can invest this one as also at 10%. It means that you are going to be paying interest 2,000, but you'll be receiving, if this is a year, you'll be receiving an investment income or interest income of what? 1,500. On what amount are you receiving the interest come? It is the 15,000 of the amount that you have borrowed. So this will be the interest expense. This will be an interest income. You are paying expense of 2,000. You are receiving income of what? 1,500 on the same what? Amount that you borrow. So in actual sense, you are only paying an interest of what? 500. So if you count to the borrowing cost, which is specific, it is the actual interest minus any investment income on the what? on the unutilized what funds. That is how we do the calculation of the borrowing cost for specific borrowing. The interest calculation is on the full amount. It will be on the full amount. But if you are rational being and you have invested the remaining portion of the loan that you are here to use on the assets, the interest that you are going to be getting over there will be net against the expense. Then the net amount will be the what? Will be the borrowing cost that will be capitalized. Let's pick 2 questions on the specific borrowing. Then we move on. Let's pick 2 questions on the specific borrowing. Okay. Then we pick 2 questions on the general borrowing too. Okay, then we know that we are done with borrowing costs. All right. So let's move from simple to complex. That example is very simple. So you don't have to worry yourself. Okay. Let me pick a very simple but technical question. Okay, let's take the question 15. It's very simple, but it has a lot of issues. Okay. Question 15. Who is going to take the question 15 for us? Question 15.
Mofo has borrowed 2.4 million to finance the building of a factory. Construction is expected to take 2 years. The loan was drawn down and incurred on 1st January 20X9 and work begins on 1st March 20X9. 1 million of the loan was not utilized until 1st July 20X9. So Mofo was able to invest it until needed. Mofo is paying 8% on the loan and can invest surplus funds at 6%. In accordance with IAS 23, show and explain accounting treatment of the above information for the year ended 31st December 20X9.
All right. So when was the loan taken?
January.
So construction starts at when?
At March.
Okay. So let's take that. So the loan was obtained. So let's look at. So loan. The amount of the loan is what? 2.4.
Yes.
Okay. 2.4. And this was obtained on January 2X9. Okay. Construction starts on what?
March.
Okay. Is it 1st March or at the end of March?
It's 1st March.
Okay.
Our work begins on 1st March 20X.
Okay. So that will be March 1, 20X9. Okay. So they're asking us to do this for what? At the end of December, isn't it? Okay. Okay. So if this was taken on January 2X1, it means that from January to December, that is a full year. But out of that full year, construction starts on only March. So we doing the 2X9, during 2X9, work was done for only 10 months, isn't it? Work was done for only 10 months. Am I correct?
Yes.
Okay.
Yes.
So it means that we are going to capitalize for only 10 months. So we capitalize only 10 months interest. Okay. What is the interest rate?
8%.
8%.
That will be 0.08 multiplied by the full amount. This is a specific borrowing. Whether you use all the funds or not, it's a specific borrowing. As soon as you have used 1 cedi of the amount, you have to charge the interest on the full amount. So it will be on the 2.4 million. Then we'll now multiply by 10 over 12. Am I correct?
Yeah.
Yes. Yes.
Or you can first find the borrowing cost before you share it 10 months and 2 months. So you can do it 10 over 12 over here. This is the borrowing cost to be capitalized. Okay. What are we getting?
1.92.
0. Point.
1.92.
Hey, check it again.
0.16.
0.16.
Okay.
It's 0.16, please.
Okay. So we have 0.16 million. Okay. Then let's count to borrowing cost to be expensed. So the borrowing cost to be capitalized will be March to December. Am I correct?
Yes.
So borrowing cost to be expensed will be January and February, isn't it?
And February. Yes. 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 Yes.
So that will be 0.08 times 2.4 times 2 over 12.
Hey. 0.032.
Okay. 0.032.
032.
Okay. So the question now is, was all
Somebody
the...
should confirm, please.
Okay, let me confirm.
Correct.
Somebody should confirm.
It's correct.
Okay.
Okay.
The question now is, like, had the company used all the 2.4 million on the project?
No.
Okay.
No, sir.
Okay.
The 2.4 million.
Okay. They haven't used all of them.
No,
Is
they
it?
haven't used because 1 million was not utilized until
Okay.
July 1st July 22x9.
Okay. So it means that on 1st March, they used only 1.4 on the
Yes,
contract.
1.4 was used.
Okay. And the remaining one was used on 1st July. So maybe during the year, they have used all the 2.4, but it was no use at only one time. It was no use at once. It has been used in a bit. They have used 1.4 first, and they have now used what? 1 million. So it means that from the time that they have used the 1.4, they will be investing the 1 million up to the time that they need it. Okay. So they will start investing the what? They will start investing the they will start the investment of the 1 million from January to what?
To June.
To June. Okay. So it means that they have all the this thing, they have all the money, they have the 2.4 at the beginning of the year, but 1 million was not used until 1st July. So from January to June, it means that they have invested this amount of money. So, but the question now is, what portion of this will be considered as the construction period, and what period of this will also be considered as the non-construction period? So construction starts on March. So March to June will be the what? Will be the capitalization period. By January and February will be seen as what?
That period will be expensed.
Okay. So we are going to calculate the finance income. March to June will be capitalized, and January to... So let's look at the investment income. So the investment income, March to June is how many months?
4.
Okay, so that will be 0.06 times 1 million, isn't it? Times 4 over 12. Okay, don't say that someone should be thinking that, okay, they have started a construction on March. So it means that the 1 million, they started saving the 1 million from only March to June. No. Before they will even allocate the funds, they have already made a plan from what? From January that, okay, this is the amount that we are going to spend, and this is the amount that we are not going to spend. So they will start the investment from January. It means that at the time that they have taken the loan, they already have the plan. That this is the amount that we are going to use from this date to this date, and this is the amount that we are not going to be using. So this is not from March that they start what, or they started the investment with the 1 million. They have already know the plan of the amount that they are going to spend. And the one that they are not going to spend, they will start investing it. So we calculate March to June. That will be how much?
$0.02.
0.02. Okay, let's look at the
January, February.
January, February, the expensing period. Okay. So that will be 0.06 times 1 million times 4/12.
So why are we using 4, not 2?
2, sorry, it's supposed to be 2. Okay.
0.001. 0.01.
Okay. 0.01. These are all income, isn't it? Okay.
Yes.
From March to December, we are paying interest of 0.016, isn't it? But from March to June also, we are receiving income of 0.02. So what will be our net amount that we are paying? So the amount to be capitalized, borrowing cost to be capitalized, borrowing cost to be capitalized, borrowing cost to be capitalized will be equal to the borrowing cost or the interest minus the interest income. So it means that from March to December, we are going to be paying interest of 0.16. But from the same from the same period, which is the March, we are receiving an income of 0.02. So it means that our borrowing cost to be capitalized will be the difference between the two. So the borrowing cost will now be equal to 0.16 minus 0.02. What are we getting?
$0.14.
Okay. 0.14.
That's Linus.
Yes, please.
Yeah, the 0.16 minus the 0.2.
Yes, please.
Why are we not adding because the top there, we didn't indicate any period. If it is from March to June, I understand. But here, because we didn't put anything, the question I'll ask is, why are we not adding the 0.01
The
to the
0.02
0.02?
will fall under the profit or loss. So it will be net against the 0.032 here.
So that one will fall under the profit and loss account.
Yes, please. Within that
all right.
period, this thing was expense. So if you count the profit or loss account as this one, that will be expense. So borrowing cost expense. So for the investment income, you only calculate for the what? For the one that fall within the construction period. So this, you will come here. The one that will be expense will be the interest itself, which is 0.032. Then you have the interest income, which will be 0.01. Okay. What are we having?
0.022.
Okay, 0.022. So this is what will go to profit or loss. And this is what will be added to the initial cost of the asset. So you have to show this. So in the balance sheet, or they can sometimes ask you to find the total cost of the assets. So if you want to find the total cost of the asset, it is the expenditure incurred on the asset that you have, the cost that you have incurred on the asset so far, which will be we have spent all the 2.4. Then you add your borrowing cost to be capitalized, which will be the 0.14. Then you add a 2. That will be the total cost of the assets. So they can ask you for the total cost of the assets. You just ask yourself, what was the expenditure incurred on the assets so far? You put them together. Then you just add your borrowing cost to that particular amount. Then you just add your borrowing cost to that particular amount. All right, let me solve the last 18 question for financial reporting. Then we look at general borrowing. Then we pick additional 2 questions and see. So the last question over there, which is the question 16. Okay, this was Cooper reporting question.
Hello, Linus.
Yes, Inia.
Yes, we haven't done it in such a way that when we go to the P&L, what figure are we sending there? When we go to the what's the name?
Profit or loss?
Profit or loss, where are we putting it? When we go to the statement of my children.
Okay, this is the profit or loss one, which is the 0.22 over here is the profit or loss. Okay, if you come to the total cost of the asset, this is the one that will go to statement of financial position. So let's add that one and see. So 2.4 plus 0.14. So that will be
2.54.
okay, 2.54. So this is what will go to statement of financial position. So the statement of financial position, the only thing that you send over there is the cost that you have incurred on the assets so far, including the borrowing cost. So we have incurred all the 2.4 for this particular year because we spent 1.4 to July and we spent the remaining 1 million from July to December. So we have spent all the 2.4, but we are also having a borrowing cost of 0.14. The borrowing cost will be added to the cost of the asset. So you are going to be having 2.54. Then that will be the cost of the asset for this year. And that will be shown in the statement of financial position as work in progress or anything. We don't depreciate an asset that is under construction. The asset is not ready for use, so we don't depreciate it. Okay. Maybe in the exam, they can give you that the asset is having a useful life of this one. Then you say that since they have incurred 2.4, they are going to use, no, the asset is not ready for use. We only depreciate an asset that is ready and available for use.
Yeah, Linus, let me worry you some.
Okay.
So, Linus, let's assume that I'm just thinking aloud. Let's assume that the figure that the 1 million that was unused, the 1 million that we needed to invest.
Yes, please.
Let's assume that it was in CDs. Meanwhile, what we are going to use it was in dollars, and then the figure happens to depreciate. What do we do?
So you find the exchange rate differences and add it to the cost of the assets.
You add it to the cost of the assets.
Exactly. So they will give you the exchange rate. They will give you the exchange rate. So you just calculate. So they will give you the exchange rate. Let's assume that they will give you the exchange rate like this. Okay. Maybe the time that maybe we have taken the loan. Maybe in dollars. Okay. We have taken the loan in dollars. And let's assume that we are also investing in dollars. But our presenting currency or our presentation currency is Ghana cedis. So what do? We have to translate these things into Ghana cedis. So what we do is that you calculate the interest on this one, all right. But at the time that you want to compute or you want to do the interest, you now have to what? You now have to translate it. You now have to translate the interest. So they will give you a translation rate. But what you do is that where you are going to see the exchange losses will be the capital. So maybe you have 2.4. The time that you have taken the loan, it was 5 CD to $1. Now, at the end of the reporting date, it's now 6 cedis to $1. You can see that the rate has increased by 1 CD. So you find the increment, which will be 2.4. That will be the loss. That will be the loss. So this particular loss will be added to what? To the initial cost of the asset as the exchange rate differences. Okay.
Okay. All right. Thank you.
Okay, let's take the 16. The 16 over here, these people, they don't have question. The 16, this question 16 was corporate reporting 20. It was May 2020 question that they have just changed the figures. Okay, so last time I was saying that sometimes they will bring the corporate reporting questions to what? To financial reporting, because they know that financial reporting students cannot go and look at those questions. All right. Okay, let's
Wanda Limited incurred the following borrowing costs during the financial year ended September 2022. Overdraft interest 14,400, foreign currency loan interest 100,800, foreign currency exchange differences on equity 168,000. In addition, a 3-year fixed rate 2.4 million loan was borrowed on 1st January 2022 at 6.5%. A loan setup fee, that's transaction cost of 24,000 was incurred. This increased the effective interest rate on the loan to 6.88%. In accordance with IAS 23, calculate the maximum amount that could potentially be capitalized as borrowing costs for the year ended 1st December 2022, assuming an asset was being financed using all available finance.
Okay. So before you even do any calculation, what are some of the figures that will be capitalized over here? What are some examples of borrowing costs in this particular thing? What are some of the examples of borrowing costs here?
I think there's overdraft interest.
Overdraft increase.
Okay. So overdraft interest will be the first one. What again? Which one again?
Exchange difference.
Which of them?
Foreign currency loan interest.
Foreign currency exchange difference.
Okay, so this will also be what? But what about equity?
Equity is not loan.
Equity is not loan. That is very important. We are looking at borrowing costs. So anything that has to do with a loan. If you are using equity, that means that you are also issuing your own shares to what? So you have sold the shares, but you are not using the cash to what? To finance the distance. That is not a borrowing cost. So equity is not going to have any effect. But anything that is dealing with loan, borrowing cost. So we are going to have the overdraft as the first one and the foreign currency loan interest. Okay. Let's come to the next one. In addition, a three-year fixed rate 2.4 million bond loan was borrowed on 1st January 2022 at 6.5%. A loan setup fee, transaction cost of 24,000 was incurred. This increased the effective interest rate on the loan to what? 6.88. So how do we account for this? How do you account for this? It will be accounted for under the what? The provisions of what? IFRS 9. Because they have given you effective interest rate. So you have to capitalize the what? The transaction cost. So assuming you are not giving effective interest rate, you are giving only 6.5. You are giving only 6.5. So what you do is that the 6.5 will be calculated. That will be the interest. You are going to calculate the 6.5% on this. That will be the interest. That will be the interest on the loan. But you have also incurred a transaction cost. And this particular transaction cost will be amortized over 3 years. So what you do is that you calculate the interest on this one separately. Then you also take 8,000 out of that and add. But this one, they have given you effective interest rate. It means that they have taken into consideration the 8,000 amortization and also the 6.5% interest on this one. So you capitalize the transaction cost and use the effective interest rate. So let's look at that. Question 16. So the borrowing cost, the first one will be the bank overdraft interest or the overdraft interest. So we have the overdraft interest, which will be, that was what? 14,400. 14,400. Okay. Foreign exchange differences. Okay. That was how much? That was 100,000 and 800. So 100,000 and 800. So what we do now is that you now do the finance cost relating to the loan. Okay. This one you can do the calculation inside this place, or you can go and do workings for it. So if you like, you can do workings for it. So what will happen is that you have your fair value or the nominal value. So you have your nominal value, which will be 2.4 million. That will be 2,400,000. Then you have your transaction cost. Then you have your transaction cost of 24,000 to be subtracted. Okay. What are we going to be having? The difference will be what? 200 and what?
16. Wait. 3,
2, 3, 7,
3,
6.
7, 6.
Okay, 276,000.
2, 3, 7,
2,
6.
3, 7, 6.
Okay. Okay, 2,376,000. Then you now have your finance cost. So your finance cost will now be charged using the effective interest rate. So 0.688 multiplied by the 2,376,000. What are we having?
$163,000.
Okay, I'm getting 163.
Yeah, 468.
469. Okay.
Okay.
Linus,
Yes, please.
how do you know when to subtract the 24,000 from the 2.4 or when to ignore?
When you are giving effective interest rate, then it means that without the effective interest rate, this is how we are going to account for this particular transaction. Okay. We are going to be paying 6.5% interest on 2.4 million, isn't it? Senior Nick, is that the case for the first one?
Yes.
Okay. So how much are we going to be getting?
So you get 0.156.
Okay. So that will be 156,000, isn't it?
Yes.
Okay. This is the interest that we are paying on the loan. But in addition to this loan, we have incurred what? A transaction cost of 24,000, isn't it?
Yeah.
These additional costs. But this is relating to a loan that will last for 3 years. So what we do is that we divide by 3. and that will give us 8,000. So the total borrowing
Yeah.
cost will be the interest that we are paying and also the amortization of the auxiliary cost, which is the transaction cost. And that will give us how much? Let's add it and see. Plus 8,000. I'm having 164.
164.
Okay. This is the amount that you should add as a borrowing cost. Okay. But they have
Yeah.
given you an effective interest rate, which is 6.88. It means that the effective interest over here has taken into consideration the 156 and also the 8,000. So what you do is that you are not going to amortize the 24,000, but you are going to capitalize it together with what? The loan itself. So it means that if you subtract it from this one, if you apply the 6.88 on this particular amount, it will be equivalent to the total amount that you should have capitalized if there was no effective interest rate. So you can see that it is 1633469. Maybe it is because of the approximation, that is why they give us the 6.88. It must be 6.88 something something, so that if you apply the full figure, you will get a 164. So you only capitalize when you are giving an effective interest rate. If you are not giving effective interest rate, you account for the two separately. You account for the two separately. So the 163 over here can be splitted as 156 for the interest on the loan, which is the actual interest, and the remaining portion will be the amortization of the transaction cost. So you can split this particular figure like that. As a interest on the loan, then you also write amortization of the finance cost. Deborah, your hand is up.
Hello, sir.
Yes, yeah.
Perspective concerning this example whereby we have the effective interest rate and the nominal interest rate. In exams, when maybe we have done or we solve using the normal interest rate and we get the 164,000, and maybe the effective interest is given us the 163, will they give us correct, or we are supposed to use the effective interest rate?
They have a reason for giving you the effective interest rate. So you will just account for it when there is an effective interest rate.
Okay.
All right. Okay. So Senior Nick, I hope you are clear now.
Yes, sir.
Okay, so you just add this one up. That is all about this particular question. But before you can solve this question, you need to understand what constitutes what a borrowing cost. What constitutes a borrowing cost? Let's look at what we call general borrowing. What we have looked at right now is specific borrowing, where the loan will be taken specifically to finance the operations of or the construction of that particular asset. Let's come to a situation where the company will be taking the loan somewhere to finance. The company will use, maybe we have taken a loan from this place, we have taken a loan from this place. So we are taking a multiple loan to finance the operation of this particular asset. That's what we call the general borrowing. You see, whatever is going to happen is that a company can have a 9% loan note that will be for 10,000. A company can also have 11% loan notes that will go for 20,000. Okay, you can see that we are paying interest at a different rate on these particular loans, isn't it? But we want to use a fixed amount to determine the amount that we are going to be capitalizing. So what do? We need to find a fixed amount. How do we find a fixed amount? If you look at the interest that we are paying on the 9%, the interest will be, okay, this will be 10,000. The interest will be 900. Am I correct? The first loan will be at 900. The interest on the first loan will be 900, isn't it?
Yes, sir. Nice.
Okay. The second will be 2,200.
Yes, the second will be 2,200.
Okay. The question now is, what is the total interest that we are paying? We are paying
3,100.
3,100. Okay, this loan was paid on 10,000 and 30,000. So the question now is, what is the total amount that we are paying this 3,100 on? It is on Yeah, but conclusion as on what? I don't understand the conclusion. As in what? So if you can put what you are talking about over there, I would like. But I don't understand the conclusion that you are talking about. Okay. So we are paying.
Linus, let me talk for that. I'm not talking for the person, but let me. Maybe we didn't do the P&L and the statement of financial position on it. You know, the corporate reporting, we maybe we will go up to that level, but this one is not included in that.
Yeah, we don't have the cost of the asset. We don't even have the cost that we have spent on the asset so far. So we don't have any cost to add this particular amount to. And even there is no amount that will be expense. There's no amount that will be expense over here. Even the amount that will be expense over here, maybe that might be, let me see the
Finance cost,
so there's no
finance cost.
no, the finance cost will be added to the borrowing cost. That is the finance cost.
Added to the borrowing cost. Okay.
Yes, please. Okay. So the answer, put the answer together. So if it is the answer that you're talking about, the figures are there, just put them together. Okay. All right. So if you talk about general borrowing, we are using different kinds of loan at a different interest rate. So what we do is that we ask ourselves, what was the total interest paid for the amount that we are using for the loan? So the total interest over here is what? 3,100. This total interest was paid on total amount of what? We have paid the interest on the loan of 10,000, loan of 20,000. So we are paying 3,100 on what? 30,000. So the question now is, we want to find a rate that if we apply it on this particular amount, it will give us the interest of this, because we are paying this interest on this amount. But this interest was calculated using different rates. But the question now is, what rate on this amount that we are paying this interest on, what rate on this amount will give us the 3,100? What rate? And how do we calculate that particular rate? Okay, now I'm going to bother you with some mathematics, but don't worry. Okay, how do we find this? It is the rate times the 30,000. That will give us the interest of what? 3,100. Okay, so if you are doing this is the same as x over 100 times 3,000 is equal to 3,100. Okay, we can say that this is 30,000 x is equal to 3,100 times 100. Divide both sides by 30,000. 30,000. Okay, so x will give us 3,100 over 30,000 times 100. Okay, so we can say that if you want to find the interest rate, that particular interest rate, that if you apply it on 30,000 will give you this one, is calculated as, which we call the WACC. So the WACC is the different interest, the different loan that we are using. What is the interest rate that we are paying on them? What is the total interest? What is the total amount that we are paying the interest on? So what rate, if we apply it on the total amount, can give us the interest that we are paying? That is what we call the WACC. So that will be calculated as 3,100 over 30,000 times 100. We can say that this is calculated as the total interest over the total amount or total value times 100. Some people can also calculate this like this. Okay, they can calculate this like this. This will give us 0. They can calculate 0.09 times 10,000. Okay, all over 30,000 plus 0.11 times 20,000 all over 30,000. You can see that 30,000 are the same. So you just add the top. Some people can also calculate this like this. Or sometimes there's a long formula that people have been using. There's a long formula that people have been using. That is too long for you. Just calculate total interest over the total amount. That is it. But you have to know that for the general borrowing, we time apportion the what? The interest, because this amount that we have taken, it was not purposely for the what? The construction of the asset. We took it for a different activity. But since we are not able to use all of them for that particular activity, that is why we took part to construct or to finance the construction of the asset. So we only take into we mostly take into the consideration when the loan was what? Spent on the what? On the activity. So you can take the loan for maybe to purchase property, plant, and equipment. So you have used part, some is left. The loan was not taken specifically for the construction of what? The building. So when did you put that particular, or when did you spend that particular amount on the building? The capitalization will start from the date that you spend it up to the what? To the date of what? Completion. That is very important. So for general borrowing, we take into consideration the timing of what? The loans. Okay. Let me just pick one complex question, and we know that we are done with it. All right. One thing I want to say also is that sometimes they'll give, we are going to look at the question 9. Okay. But sometimes they can give you, let me look at this question and see what I want to say. There's a question that they'll give you closing balance and opening balance. Okay. They will give you closing balance and opening balances. Look at this question, question 4. Okay. Question 4. You can see that you are giving the loan at beginning and at end, but you can see that one of them are not the same. One of them is not the same. You can see that we have what? 60,000 against 160,000. But the question now is, which of them are we going to charge the interest on? Which of them are you going to charge the interest on?
The 160.
Are you sure?
Yeah, that's what at the beginning.
Okay, but that is not the money at the end.
Then they will charge the interest on the difference.
No,
You add them together and charge.
No. It's not that they are two different ones. It's not that you have taken 240 at the start of the day and you have taken another 240. No, the 240 at the beginning is the same as the 240. You haven't paid any part. So it's not a different loan taken. It's just the loan that you have taken at the beginning and the closing balance of the loan. So it means that they have paid some part of this one, isn't it?
Yes.
Okay.
So finally, the second one, the 19. The way we have the 160 and the 60, it means that they have already paid the 100,000.
Yeah, they have paid 100,000 here.
Is that implication?
Okay.
Okay.
If you go to a bank to take a loan, would they charge the interest on the money that you are owing them at the beginning, or they will charge the interest on the amount that you are owing them at the end?
They will charge the interest, the amount you took at the beginning.
Okay. That is if you are using, we also have what we call the payment will be done on fixed interest rates, and the payment will also be done on a reducing balance basis, where they will only charge the interest on the remaining amounts, where they will only, maybe stable. No, I mean, you know, I use your Wi-Fi. Okay. All right. So if you are using the fixed amount where you are going to be taking a loan, and the loan, they are going to, if whether you have paid the amount or not, they are going to be charging in the same interest. Okay. But there are some of the loan that the interest will be charged on reducing balance basis. That means that any amount, if you have taken 160, okay, you have taken 160, now you have paid 100,000. It means that you are owing me what? 60,000. Okay. So I'll only charge the interest on the remaining amount that you are owing me because you have already paid what? The 100,000. Okay. But there's nothing that is being said over here that if the loan is on reducing balance basis or it is on fixed amounts. So we assume that whether you pay or not, the interest will be fixed every year. Are you okay? So you charge on the what? On the opening balance. Whether you have paid or not, the interest payment is fixed. It is not changing. The interest payment is not changing. So you charge it on the what? The opening balance or the actual amount that you have taken. Sinners, are we okay with that? All right. So they can also say that the loan is being settled on reducing balance basis. That means they only charge the interest on the what? The balance on the accounts. Okay. So that one, let's take question 9 and finish it. So let's take question 9 and finish it and see whether we can. And give me.
XYZ company secured a 20% loan facility of 800,000 for the construction of a two-story building on April 1, 2014. Construction of the said project commenced on January 1, 2014. The following is the expenditure pattern on the assets. January 1, land acquired for the construction. March 2014 is an expense. April against the words. Before the drawdown of the loan facility, financing of the asset was done from an existing pool of funds as follows: 18% long-term loan of 600,000 and a 25% medium-term loan of 350,000. All expenditure paid for after the drawdown of the project specific loan was funded by that loan except to the extent that it exceeded the available fund on the facility. Excess funds on the facility loan was temporarily invested at an interest rate of 9%, and interest was payable monthly in arrears. The building was subsequently completed on May 31, 2015, and became available for use on July 1st, 2015. XYZ has a policy of depreciating building at 5% per annum on straight line basis required. Show how the above will be treated in the books of XYZ for the year ended December 2014 and 15. This should include extracts of statements of profit and loss and financial position.
All right, Sina, thank you. So the company secured a 20% loan facility of 800,000 for the construction of a two-story building on 1st April 2014. Construction of the said project commenced on January 1, 2014. The following is the expenditure patterns on the assets. Okay, so when do we acquire the 20% loan? Is what? Is it a specific loan or is a general borrowing? Is it a specific borrowing?
Loan.
Okay, so the 20% is a specific borrowing. Okay, but the loan was taken on 1st April, isn't it?
Yes.
Okay, but construction starts on what? 1st January. Okay, it means that 1st January, 1st March, we were using the what? The general borrowing for what? For the construction. Okay. But from April 1, we will start using what? The specific borrowing, isn't it? Okay.
Yes.
The question even said that before the drawdown of the loan facility, the financing of the asset was done from an existing pool of funds. Okay, let me say this one. You can take a loan. You can take a loan to construct the asset, but you are not going to make any transfer from the loan to the asset. In that case, you can't capitalize so you can see that although although this amount was taken on 1st April, the company can still take this amount on January 1. But what will happen is that they will still continue using their what? Their existing borrowing. So they won't touch this amount. Since they haven't touched this amount, the interest from January to the time that they are going to touch it, it will be expense because no expenditure on borrowing costs has been incurred on the assets. We haven't used any amount of that particular loan that we have taken on the assets. So so that is it. You can take a loan, but you won't use it on the what? On the assets. You can't capitalize. You can only capitalize the borrowing cost when an expenditure or a borrowing cost has been incurred on the assets. So take note of that. So before they were doing it means that the 1st January, the 1st March, they were using this existing what amounts. Okay. Let's go forward to see what they are saying. Okay. All expenditure paid for after the drawdown of the project specific was funded by the loan except to the extent that it is exceeded the available fund on the facility. Okay, what they are saying is that all expenditures paid for after the drawdown of the loan was funded by the loan except what? That it exceeded the available fund on the facility. So what they are saying is that after we have taken the loan, all the expenditures that we have incurred or we have paid for after taking the loan, we are taking out from the what? The loan that we have taken. So it means that from 1st April, we are going to be paying from this one. So we have paid 260 from what? The 800. What will be the remaining amount?
Five, four,
540.
So that will be 540. Okay. August 1. We are going to be paying from the loan again, isn't it? Okay. So that will be remaining 240. Okay. February 2015. We are going to be paying what? 240, but we are making an expenditure of 400. So we go to the general borrowing again, or the existing borrowing, and take 160 out of it. So the question now is that they are asking us to do what? What are they asking us? They are asking us to show how the above will be treated in the books of this one, included in the statement of financial position for the 2 years. So let's take it one by one and move on. Okay. You can see that from the beginning, we were using the existing borrowing. So what we have to do is that we have to find a WACC for the existing borrowing. So let's calculate the WACC for the existing borrowing. So let's calculate the WACC. So the existing borrowing, it will be 18% multiplied by this amount. So 0.18 times 600,000. Okay. So we have 0.18 times 600,000 plus 0.25 times what thousand? So that'll be 250. Okay, that will be 350. So 350,000. 350,000. All divided by 600,000 plus 350,000 multiplied by 100. What are we getting? This one, you don't have to waste time on it because it's not part of the max. So you just have to put your distance there and find it. That's all. Okay. So I'm getting 18,000 plus. Is that correct? Please, can you hear me?
20.57%.
Okay, the total is 20.57%.
Yeah.
Okay, so let's just use a 20.57 or 20.6. Okay, 57% is okay. All right, so this is our WACC. This is our WACC. So we can now go on to calculate our borrowing cost one by one. Okay, so let's come to the borrowing cost relating to, let's do it for general borrowing. So let's do it for general borrowing and the specific what? Borrowing. So the general borrowing, we are going to be having January to December. The January to December will be the first amount that we have made. So let's come to the first transfer. The first transfer was made on what? The first transfer was made on what? January 2014. That is the beginning of the year. So we have transferred what? 155,000 to purchase the land. So this particular amount is going to be using what? It's going to be used for the full year, January to the end of the year. So what we do is that we use our borrowing cost will be the 0.2057 times 155,000. What are we getting?
31,884.
Okay, 31,884.
884.
Okay, then let's come to, this is the first one. This is based on the first payment. Okay, if you like it, you can do it long, but me, I'll do it one so that it will be okay for you. You can see that the second transfer will also be made from the what? The existing borrowing, isn't it? Okay, that will be from March 1 to what? December. That will be, it will take 10 months. Am I correct? It will last for 10 months. It will last for 10 months. Okay, am I correct with the 10 months? March 1 to December.
Yes.
Okay.
Yes, you are correct.
That will last for 10 months. And the amount is what? 180. Okay. So we come to March to December will be 10 months. So we have 0.2057 times 180,000. What are we having?
37026.
Okay. 3702. Okay, 026. All right. Let's come for the.
Not you factor the 10 months. Oh,
Okay, sorry. 10 over 12. I was in 10 over 12. So that will give us what?
3855.
Okay,
3855.
3855. Sorry, I was doing the 1 year again. That will be 30. So it means that this loan will be used for following 10 months. It's not a specific loan. So this one, it is a loan for other facility, but since we don't have money over there, then we have taken it from that one to use it on this particular one from that date. So that will be used for 10 months. But let's come to 2014. We are doing 2014 and 2015. 2014 and 2015. So do we make any transfer from the existing borrowing in 2014 again? No. So we now come to what? The specific borrowing. Let's come to the borrowing cost for the specific borrowing. So the specific borrowing, whether we have used all the amount or not, since we have taken the loan for this particular one, the interest will be charged on the full amount. So April to December. Okay, that will be 0.2 times 800,000. Multiplied by how many months? Would that be 9 over 12?
Yes.
Okay. How much are we getting?
Daddy.
120,000.
Okay. 120,000. But the question is, did we use all the 800,000 on this date? No, we
No.
didn't use all. So it means that we have used what? 260, isn't it?
Mhm.
Okay. We have used 260, so it will be remaining 540, isn't it? Okay. This 540 on August 31, we have used what? 300,000. So it means that what will be the remaining amount over here? What will be the remaining amounts? What will be the remaining amount? Or what portion of the amount 800,000 we have used for this year? That will be 800 minus 260 minus what? 300. So we have used
560. We've used 560. Oh,
okay, we have used 560 and 240 will be remaining, isn't it?
yes.
Yeah.
Okay. So the meaning is that we have invested 240 of this amount from this day to the end of the year. Do you agree to that? 240 of the 800,000. The time that we used 260, the remaining amount was 540. 240 of it was invested from April to December. Okay. And 300 of it was invested from April to 31 August 2014. Do you agree to that?
Come again.
Okay. I will take it again. All right. On 1st April, we have made a transfer of what? 260 from our general borrowing, isn't it? So we are left
Yes.
with what? 540, isn't it?
Yes.
Okay. From April to August, we have made another transfer of 300,000. Are you okay? All right.
Yeah.
So it means that from April to August, we have invested the 300,000 at the beginning of April to the end of August. At that time, then we go to the bank and withdraw and pay to the people. Do you agree to that?
Yeah.
All right.
Yeah.
240 was invested from April to the end of the year because we didn't tie the 240. So we are going to have 540 over there in the investment. But from April to August ending, we are going to be withdrawing what? 300,000. It means that 300,000 have been invested from April to August, but the 240 will still be there. The 240 will still be there. Another way of going about this one is you do 540 from, you will say that you have invested all the 540 from April to August.
Yeah.
Okay. The
Then you do
September,
Salama,
yes, Inia.
I'm lost. I don't know where you are getting the 540 from.
Oh, the loan that we have taken is 800,000. The specific loan that we have taken is 800,000 here, which was taken on 1st April 2014. Okay.
Okay.
But this one, the question says that all expenditure are paid for after the drawdown of the project specific loan. The project specific loan was 800,000. So from 1st April, we are making all the investments from the specific loan. So from 1st April, we have taken 260 out of the loan. So it means that we are having 540 left. Okay. This 540 on 1st August 31, on August 31, 2014, we have taken 300,000 from it again. It means that there will be 240 left in the account. So I'm saying that you can also break down this particular 540 like this. You can break it down like this. Anyhow you want to do it, it is fine. Okay, so you have two ways of breaking it to calculate your investment income. So the 540 over here, you can say that, okay, 240 of it was invested from April to December, because 540 that we put there from April. On August 31, we went to withdraw what? 300. It means that the 240 is still there. The 240 is still there. But the 300 out of this one was invested from April to August. Put it there from April to August, then we go for it. Or I'm also saying that the 540, you can also go about it like this. You assume that from April to August, all the 540 was there. So you invested April to August, you invested what? All the 540. But at the end of August, you went for 300. It means that from September to December, you have only 240. But you can see that the 240 was there from April to August and was there from September to December. So you can say that 240 was invested from April to December, whereas the 300 was invested from April to August. So let's calculate the investment income now. So the investment income, any excess amount will be invested at 9%. So let's go and calculate that particular amount. Okay, so let's look at the investment income. Investment income for this. So we have April to December for 240. That will be 0.09 times 240,000 times April to December is how many months? That will be 9 months. So 9 over 12.
Yeah,
What are we getting?
$16,200.
Okay. 16,200. Okay. So this is that one. So April to August. April to August, we are investing the 300,000. So times 300,000 times how many months? April to August is how many months?
5.
Okay, 5 months. So 5 over 12. How much are we getting?
11,250.
11.
250.
Okay. 11,250. So let's calculate our total. So you can also use the second approach. Okay. Let's use the second approach, which is the alternative approach. I don't think we can do the government grant today. So alternative approach. I'll add inventory to it on Saturday. Let's do the minor standards. Then we know that for corporate reporting, you will not see them, but they can put it into questions. Corporate reporting, you can see one question, then a lot of standards will be there. But I'm doing the borrowing cost because of maybe console. There can be a footnote on console, that will be on borrowing cost. Okay. So let's look at the alternative approach. We can say that from April to August, we have invested all the 540. So 0.9 times the 540 times the 5 over 12. Okay. Then we say that from September to December, we have invested 0.9 times the 240,000. And that will be times 4 over 12. So what are we getting for the first one?
$20,250.
20.
250.
Okay. The second one will be what?
$7,200.
7,200. So add the two, let's see.
$27,450.
27,450. So add this one to and see. 16,200 and 11,000
250 is the same thing.
is the same thing. Okay. So our
Yes.
total interest income will be, you can take any of them. So let me just take this one since this is the one that I have over here. Let me take this one. Okay. So we have 27,450.
Yes, 450.
Okay. So let's now come to the total borrowing cost for this particular year, 2014. What will be the total borrowing cost for 2014? So the total borrowing cost for 2014 will be the general borrowing. Let's look at the general borrowing. What is the total value of the general borrowing? it will be this amount plus this amount. How much are we having? So we have 31884 plus 3855. What is the total? I'm having
It's 62,739.
739. Okay.
Yeah.
So let's come to the specific borrowing. The specific borrowing will be equal to the borrowing itself, which is 120,000 minus the what? The interest income. I hope you agree to the interest income, 27,450. So what are we having? 120,000 minus 27,450. I'm having 92550.
550.
Okay. So 92550. So what will be the total?
One five five
280.
289.
Okay. So let's look at this is the total borrowing cost to be capitalized. Let's look at the total cost of the asset. Total cost or the cost of the asset. Let's just look at the cost of the asset. So the cost of the asset. Okay, the cost of the asset will be the amounts that we have spent so far. What is the total amount spent so far? Okay, so it is building. So let's look at, let me just write land and building here. Okay, so let's look at the total amount that we have spent so far. Then we add the borrowing to it. So we have spent what? 155 plus 180 plus 260 plus 300. We have spent 895,000. Is that true? $895,000. The last one is for the next year, which is 2015. So this will be up to 2014. This is the total amount spent so far on the construction. So that will be 895,000. So we have 895,000. 895,000. Then you now add your borrowing cost. The borrowing cost for this year, which is 155,289. Then you add it and get a total value. 155,289. So I'm getting 1050,289. Okay. This is what will go to statement of financial position. Okay. All right. But do you want to show the one that will go to profit or loss? Okay. If you want to show the one that will go to profit or loss, you can see that for this particular year, no interest relating to the specific borrowing will go to what? Profit or loss. Because construction starts on 1st January and we have taken the loan on April. So we haven't used any part of the loan before the construction. But what is going to go to profit or loss is the total loan. Let's calculate the total loan on these figures. We are going to be having, in actual sense, the loan that the interest that you have to be paying on this loan will be this amount. So we have 0.18 times 600,000. You are supposed to pay 108,000 on the first one. Then the last one, 0.25 times 350,000. You're supposed to pay 87,500. Okay, if you add it to 108,000, you're supposed to pay interest of 19,500, isn't it?
Yeah.
Okay. So the question now is, so we're supposed to pay interest of this amount. The question now is, how much of that are we charging as borrowing cost? How much of it are we capitalizing? So the 19,500. We're supposed to charge all of those amount of profit or loss, but we are now capitalizing this amount of it. So you take the difference, you take that particular amount from this amount, then the difference will go to the profit or loss. That is how we do. So it means that out of this particular interest, which is the 195,500, we are capitalizing 62,739 or something out of it. So this will be capitalized, the difference will go to profit or loss. But if none of these amounts should be used on the construction, it means that we have to charge all of this one to profit or loss. But we are using this amount. So the difference is the one that will go to profit or loss accounts. Okay. Let's count to, this is 20, let's count to 2015. Okay. 2015. Okay.
Hello,
Yes,
Lionel.
yes, yeah.
So nothing of the investment income also be verified or be at the PNL.
No, please. Because the investment income were all generated during the construction period. No investment income was generated before the construction period.
Yes. So my question is,
Yeah.
we expensing the 195 or find a difference between them, because if we look at it, realize that there was an investment income for us to arrive at the 62.
But the investment income was relating to specific borrowing. We didn't invest any amount of the general borrowing. So the interest is relating to the general borrowing. So the investment income we are computed on the general borrowing, not the what? They are computed on the specific borrowing, which is the 800,000, not the general borrowing. The general borrowing, we are not investing any part of it because it is not taken for what? For the construction. We took it for a different reason, but we decided to make some transfer from it towards the what? Towards the construction. So it means that the rest of them will be used on the what? On the remaining projects. All right. So the investment income is for the specific borrowing, not the general borrowing. Okay. Sin, I hope you're okay.
Yes, please.
Okay. All right. Let's look at 2015. Okay, 2015, we look at when the next disposal was made. It was made on February 1. Okay, it was made on February 1. Okay, so it means that we are going to be taking the 240 out of what? The remaining 240 on the 800 balance. But this will be invested for only 1 month in the 2015 year before they will make the what? The transfer. Okay. This one, we are going to be taking 160 out of the specific borrowing. Okay, the question now is when was the what? When was the building completed? When was the construction completed? The building was substantially completed on 31 May 2015 and become available for use on 1st July 2015. Okay, so let's count to this one. Okay, let's count to the general borrowing 2015. Let's count to the general borrowing for 2015. The general borrowing will be between February to what? To May. It will be February the beginning to May. That is when the next transfer from the general borrowing was made. So we have the next transfer from the general borrowing was made on 1st February. And this is going to last from February to what? The time that the building was completed, which is 31 May 2015. So what we do is that our February to May will be 0.2057 times the 160,000, which was a transfer, multiplied by, okay, February to May is how many months? Would that be 4 months? So we have 4/12. Would that be 4 months?
It is 4 months.
Okay. So 0.2057. How much are we getting?
Ten 971.
Okay.
10,971.
Okay. So 10,971. Let's come to the specific borrowing. The specific borrowing, when is it going to start? You see that the funds will still be from January to what? May. Am I correct? Because the construction will still resume from January. So it means that the loan will still be from the beginning of the year to May is still the construction period. So it doesn't matter when the investment or when the transfer was made. No, the calculation of the borrowing cost is based on the total amount. So this one, it will still be from January to May. And this will still be 0.2 times the 800,000. Okay, the calculation will still be on the initial amount. So it will be 0.800,000. This is the amount that we are borrowing from them. And payment of interest will start from the beginning of the year. But the beginning of the year is still within the construction period. So this will last for only 5 months. So we have the 0.2 times the 800,000 times 5/12. What are we getting?
$56,667.
So I'm having
Correct.
667, isn't it? Okay.
Yes.
Would there be any investment income?
Yes.
Okay. There will be an investment income on the 240 for only 1 month.
Yeah.
Okay. Because at the end of 2014, the balance on the specific borrowing account was 240. But the next transfer was made on 1st February. So it means that the money is still in the account at the beginning of the year to February. So this will be invested for just a month. So we look at January to February. That will give us 0.09 times 240,000 times 1/12. What are we getting? I'm getting 1,800.
Yes.
Okay. So let's look at our borrowing cost, our total borrowing cost. Our total borrowing cost will be the general borrowing of 10,971, the specific borrowing will be 666,667 minus 1,800, which is the investment income. What are we getting? We're getting 6,487,867.
Yeah.
Okay. Plus 10,971. I'm having 75,838.
838.
Okay. So let's come to the land and building. So what will now be the value of the land and building at 31 May 2050, which is the completion date. Okay. So the land and building, we are going to be having the balance brought down. Okay, or the cost from that particular year, which is last year. The cost was 10,289. Okay, then we just look at amount, the borrowing cost for this year. Borrowing cost for this year is 75838. And also the amount spent in this year. The amount spent this year is what? 400,000. Am I correct? This year, the amount spent is what? 400,000. So okay, the amount spent is what? 400,000. So what will be the total amount? I'm having 1526 127. Is that correct? 1526.
Yes.
Okay. So the question now is, when was the asset ready, or when was the asset become available for use? The question says something like that. Okay. And become available for use on 1st July 2015. Okay. On 1st July 2015. But the question now is, what is the reporting date for the company? It is 31 December 2015. So it means that they are going to be using the assets for from July to December. That will be 6 months. So they have started using the assets already. Then they have to depreciate it for what? 6 months. So we now calculate our depreciation, which is calculated at what? 5%. So 0.05 0.05 times 1526127 127 times 6 months, because that is July to December. Okay, so times 0.05 divided by 2. I'm getting 38153. Is that correct? So the statement of profit or loss, you have a depreciation of 38153. Then maybe the finance cost. The finance cost, you can do the finance cost, the one that I've shown you first. You find the total cost, the total interest, which is 1,955,500 on the specific borrowing. Then you subtract the portion that was capitalized, which is this one. Then that will be 1,955,500 minus 10,791. So that will be the finance cost. If you come to the statement of financial position, you are going to have your assets, which is land and building. Then the land and building will be 19. Okay. So I'm going to have 38153 times 39. I'm having 147 148 7967. So you can also count to liabilities. Then you show the loans as a liability because they haven't paid yet. So you have your non-current liabilities, which is non-current liabilities. So then you haven't showed the loan for last year, so you can show all the loan for this one. So you can show all the loans here. The 20%, the 20% loan, which will be 800,000. Then you show the remaining ones over there. They will also show in the statement of financial position. Although we haven't shown it for the 2014, you have to show it. If you are showing the statement of financial position, you have to show it. All right, seniors, that is all about this question. You can see that It's very small, but it's some way. All right, seniors, that's all. The government grants, I won't do inventory again. I won't do inventory again. So I will add investment property to the government grant on Saturday. So if you finish it, maybe Monday, we do accounting policies and maybe foreign exchange transactions. Then we now
Go to the previous page, the 2014 page.
okay. Yeah, this is a 2014. Or I should move again.
Yeah, I think there's it.
Okay. So Saturday and Monday, we should be able to finish these sundry standards. So Saturday, maybe we try to finish the government grant together with investment property. Then Friday, we look at it, the IS8 accounting policies, estimate, and those ones, together with IS21, effect of foreign exchange differences or transactions. Then after that one, then we now focus on income tax, PPE, leases, financial instruments, earnings per share, maybe revenue. By February, somewhere February, maybe first week or second week in February, maybe we have to finish the standards. All right. So financial reporting people, tomorrow we are meeting we are going to start group accounts, okay? We are going to start group account tomorrow, 6:30 to 9:30 p.m. Seniors, if we don't have any question, yeah, I will say thank you for coming to make me confuse you with the last example. It is what? Go over it again, find the questions. If you have any problem, I'm always there. Let's see how we can go about it. Okay.